Hello, this is Craig Mitchell, your personal mortgage consultant for life. And this video that you're going to watch today is an excerpt from one of my first-time homebuyer seminars. So if you're a first-time homebuyer, this is information you definitely need to know. And even if you're not a first-time homebuyer, I can almost guarantee that most of the information will be new to you, so you can definitely benefit by watching it. If you do have any questions or comments after watching the video, please email me or call me, and my contact information will be provided at the end of the video. So today we're going to talk about one of the most important things you need to know about buying a home, and that is your credit. Now the first thing we're going to cover is your credit score. Everybody has 3 credit scores, one from each of the 3 big credit bureaus, which are TransUnion, Experian, and Equifax. TransUnion gives you a score called a FICO score, which most people have heard of. Equifax gives you a score called a Beacon score, and Experian gives you a score called a Fair Isaac score. When you apply for a home loan, the banks will get your score from all 3 bureaus, and they will use the middle credit score. So for example, let's say you have a 610, a 620, and a 630 score. Well, your middle score would be a 620, which is the score that is used to determine if you can qualify for a loan. There are 5 factors that are used to determine your credit score, and this is important. Number 1, the most important thing, which accounts for 35% of your score, is your payment history, especially in the past 12 months. Now your payment history is simply whether or not you pay your bills on time. Now the good thing is that as long as your payment is not 30 days late, it does not hurt your credit. So for example, let's say you have a car payment that's due on the 1st. As long as you get your payment in by the 30th, it does not hurt your credit. Now your lender may charge you a late penalty for being 30 days late, but it does not hurt your credit. And the size of your payment doesn't matter either. And what I mean by this is if you have 2 credit cards and one has a payment of $100 per month and the other one has a payment of $5 per month, if you make a late payment on either of those, it hurts your credit the same. I see a lot of people that they just forget to send in their payment on the small credit cards because they figure, well, it's only a $10 payment, it's no big deal. But in reality, you're destroying your credit. So be sure to keep all your bills on time. Now if you have any collections or charge-offs, do not pay those off until you talk to me first. In many cases, paying off old collections or old charge-offs can actually lower your credit score. So don't pay any collections or charge-offs off until you talk to me first. The second biggest factor, which accounts for 30% of your credit score, are your debt ratios, which is simply the amount of debt you have on your credit report compared to the amount of credit that you have available. And let me give you an example of this. Let's say you have a credit card with a $1,000 credit limit. Most people think that it helps their credit when they use their credit card, and this is simply not true. Your credit score is highest when your balance is lowest. If you have a 0 balance on your credit card, your score is going to be higher than if you have a $500 balance. And a $500 balance is better than having a $1,000 balance. So when you have lots of credit cards available that you don't use, you get rewarded with a higher credit score. Now this may not make a lot of sense because what's the point of having lots of credit if you're not going to use it, right? Well, it may not make a lot of sense, but that's just the way it is. So keep your credit card balances low. Ideally, you want to keep your credit card balance below 30% of what's available. So on a $1,000 credit card, you want to keep your balance below $300. The third biggest factor, which accounts for 15% of your credit score, is the length of your credit history. And this is where a lot of people mess up. The length of your credit history is how long your open credit has been in good standing. So let's say you have 3 credit cards that have been open for 5 years and you never use them, so you decide to call your bank and close them out. Well, that 5 years of good credit history you had with those accounts is now completely gone. Since you closed out those accounts, they're no longer used to determine your credit score. I run into a lot of people that have low credit scores simply because they close out their credit cards and they don't have any open credit that's in good standing. If you don't want to use your credit cards, that's great. Cut them up and throw them away, but never close the accounts. Now there is one exception to this rule. If you have more than 5 credit cards open, well then you can go ahead and close out some of the accounts, but make sure that you keep at least 5 accounts open at all time. Also, if you're going to close out some accounts, make sure that you close out the accounts that have been opened for the least amount of time. It's better to keep a credit card that's been open for 20 years compared to a card that's only been open for 1 year. The fourth factor, which accounts for 10% of your credit, is new credit. Now try not to open more than one new account per year. Opening lots of new credit cards can hurt your credit because it looks like you're semi-desperate, that you need to open a lot of credit to pay bills. So lots of new credit is actually bad on your credit. And the fifth and final factor, which accounts for 10% of your score, are the types of credit used. Diversified types of credit is best, meaning it's best if you have different types of credit like a car, credit cards, department store cards, as compared to only having, let's say, credit cards and nothing else. And those are the 5 factors that are used to determine your credit score.